ARK Invest's CEO and CIO, Cathie Wood, believes that we're faced with one of the biggest stock market crashes in history. And if you were looking at the signs all around, you shouldn't be surprised. Cathie Wood just warned of a stock market crash and how to prepare. If you're a subscriber, well, welcome back to Investing View. But if you're new to this channel and you want to enjoy more of our engaging content, make sure to click that subscribe button and use that trigger finger by smashing that like button. Now, let's get into it. Technology is advancing rapidly, and thanks to the lockdown, the economy is anything but stable. Cathie believes that moving forward, the new technological implementations will heavily disrupt the traditional value investing strategies. ARK Invest's Cathie Wood expects a stock market correction. Quote, "There will be a valuation reset. There will be fear." In an interview with CNBC, ARK Invest's Cathie Wood discussed the risk of a stock market correction. She said, "I do believe if rates were to take a sharp turn up, that we would see a valuation reset and our portfolios would be prime candidates for that valuation reset, of course." Now, one of the things that I found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3%. Now, if you think that's where long-term interest rates should stabilize, if you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seems to be peaking out. We think it's there, longer term. I agree there will be a valuation reset. There will be fear. The S&P companies will be replaced by these newer, innovative businesses. This includes linear TV, physical branches of retail banks, brick-and-mortar retail, freight rail, and traditional transportation. And no, you aren't alone. It sounds a bit over the top to most as well. It's hard to imagine all of these things that we're so used to just going poof, even if they're replaced by better, safer, and more efficient alternatives. But you can definitely see her point. Besides, she isn't just making wild claims here. She has data and statistics to back her ideas up. Currently, EVs are not as widespread as standard vehicles, mostly due to the price tags. But as soon as things on the battery front improve, people can expect that the prices will start dropping. Battery-related costs are one of the most significant factors that hold back EVs from taking over. As the products become more accessible for the average user, traditional transportation methods will start falling behind. Think about if both vehicles cost about the same, but one is safer, cleaner, and more efficient. Why would anyone not make the change? Cathie Wood believes that this will also change the face of the freight industry in combination with autonomous driving technology. There is a definite possibility. Now, let's talk about physical bank branches. Physical banking is already falling behind in popularity, and Cathie expects that it will be replaced by digital wallets very soon. She uses Chinese systems like WeChat and Alipay as an example here. People find it not only faster and more convenient, but also safer. The Tencent reports for Q4 2019 show over 1 billion WeChat daily transactions, and there is no reason to believe that the rest of the world won't follow suit. Digital payments are preferred by many businesses since research shows that people are much more likely to make a purchase if they don't have to go through the feeling of physically parting with their money. The reality of the situation is that banks have a much harder time acquiring loyal customers than digital solutions. According to ARK Invest, platforms like Cash App, Venmo, and PayPal have a bright future ahead of them. They expect that by 2023, over 74% of the adult US population will be using digital wallets. Now, going to linear TVs. Linear TV refers to the way people watch things on television, where they have to tune in a specific channel at a specific moment to catch the show they want to see. As most people agree, this can be rather annoying, since it requires you to free up your schedule, get home early enough, and just sit there and watch with no interruptions. But it's all designed like that for a reason, because that used to be the most efficient and effective way to serve advertisements to the audience. But looking at the stats, linear TV isn't doing so well. Cathie points out that advertising spending on TV in the United States has been flat over the last few years. Simultaneously, fewer and fewer people are even bothering to watch TV. Today, fewer than 50 million people watch TV in the United States, while not too long ago, this number was well over 100 million. A 50% decrease. The new and innovative service here is on-demand streaming, and the younger audiences are already opting for streaming over linear TV. Furthermore, streaming services enjoyed a large influx of new viewers during the lockdowns, and advertisers quickly noticed. Cathie also shares a warning for the businesses that mostly rely on passive investment strategies and index funds. All of the recent bubble talks made index funds very popular, and that's perfectly reasonable. Investing in the S&P 500 is a solid and pretty much risk-free strategy at the moment. But Cathie believes that when the industries begin to chance, the stock market won't be as stable anymore. She is mostly talking about businesses and organizations that rely on successful investments for their revenue here, but it's still worth considering. Index funds are also not, quote, as efficient as purchasing specific stocks, since you are spreading your resources over the various businesses in the index instead of focusing them on a couple of really successful companies. And as a quick side note, a large portion of the top S&P 500 companies are indeed in the tech industry, the top 10 accounting for over 27% of the entire index. This is something to keep in mind for the future. While it's impossible to predict for sure what the future will bring for the stock market, it's wise to be ready for anything. Here is how to prepare for a stock market crash. 1. Maintain a strong emergency fund. During market downturns, stock prices drop. If you're forced to withdraw your investments when prices are lower, you could end up selling them for less than you paid for them, thereby locking in your losses. You never know when unexpected expenses will arise, and you have to play it safe to avoid withdrawing any money from your retirement account. Without emergency savings, you might have had to pull that money from a retirement fund in case something happens. And if stock prices had been at rock bottom when you made the withdrawal, that could have had disastrous effects on investments. Number 2, continue to invest consistently. No matter what the market does, you must plan to continue investing consistently. Even if the market crashes, you have to keep investing as usual. Long-term investors will like this strategy. It may seem counterintuitive to invest when the market is down, but that can actually be a smart strategy to get more for your money. When the market is down, stock prices are lower. In other words, the stock market is essentially on sale, and you can snag great investments at a discount. Number 3, don't try to time the market. Timing the market means trying to buy and sell stocks at just the right moment to make a profit. On paper, it sounds like a smart strategy. If you buy stocks when prices are at their lowest and then sell when the market peaks, you could potentially make a substantial profit. In real life, however, this tactic is nearly impossible to pull off. Nobody can predict exactly when stock prices will rise or fall. Some talented market forecasters can make solid guesses about what the market will do, but even the best forecasters may be wrong more often than they're right. What can you say about Wood's prediction? Let us know down below in the comments. And hey, if you enjoyed the video, don't forget to like and subscribe to our channel so we can continue giving you the best content. Thanks for watching. See you in the next video.